Hi, everyone. I'm David Toll, publisher of Private Equity Career News. Welcome to the program. You've joined us a bit early, and so we want to reward you for that with a few insights on how to make the most of the webinar. Starting with the handouts, you should see on your control panel a drop-down called handouts, and if you go there, you can download a copy of the slide presentation from today's program. And there's also this really neat report based on a survey of BD professionals from last year, all kinds of valuable statistics on origination practices across the private equity industry. So please avail yourself of that. Also, we'd love to get questions during the program. So please use the question feature, which is on my control panel. It's about midway up. And best webinars we find, we get lots of questions, and then we get answers from our expert speakers. I'm really excited today. We've got a great topic, great group of speakers, and we're going to start the formal program in about 2 or 3 minutes. We're still waiting for more people to arrive. We do have a good portion of the country covered with our speaker slate, so I thought it might be interesting to hear a really brief weather report starting. We'll go north to south, and Nicole has the honor of going first. She's actually on the border of Illinois and Wisconsin, I believe. Nicole, what's it like up there today?
Well, it's very sunny, and we're supposed to get up to 66 degrees, but my kids asked to wear shorts, but I just don't think they're quite ready for that yet. So started at like 50 degrees when we were driving to school. So, but it's supposed to be nice today.
Okay, not quite short weather. I've got my shorts on. But I'm much further south. Ashley, you're actually in Chicago. What's going on there? And Ashley, you might be on mute. Yeah, we still can't hear you. So we're going to come back to Ashley. We're going to go to New York City. Nadim Malik, what's the weather like there?
Hi, David. Just north of the city in Westchester County, we are looking at a 55-degree, beautiful sunny day, and it's only going to get warmer later today, and tomorrow it should be 70. So great way to kick off the weekend.
Yeah, that sounds nice. So far, weather sounds pretty good. Now we're going to really head south to Atlanta. Steve, what's going on there?
Yeah, it's supposed to get into the high 70s here today, so we're definitely fully into spring, and hopefully the pollen counts are finally going down, so everybody can stop sneezing and coughing, and making everyone think they have COVID.
Yeah, pollen count is quite high here as well. I'm in just outside of Charleston, South Carolina, and it's a beautiful blue sky, sunny day. It's already in the 70s, and forecast is for very nice weather. So,
David, can you hear me?
Ashley, you can hear you now?
I pressed nothing, which is what's crazy. I'm like, wait a minute. I literally pressed nothing except that, but I just logged back out, logged back in, and I'm glad that worked. Thank goodness.
All right, Ashley, and real quick, how's your weather there in Chicago today?
It's good. Same as Nicole's, because we are not that far apart. So it's sunny, supposed to be nice and warm here. Thank goodness it was snowing 2 days ago, which was so depressing. But we're on the up. Spring is here. Summer's right around the corner.
Snow in April. All right. Okay, so I think we're gonna get started, and I appreciate those folks that got here a little bit early. Hopefully you had an enjoyable experience, and let's get started with the formal program. Good morning, and welcome to a special Private Equity Career News webinar. Topic, finding lucrative deals in a fiercely competitive market. I'm David Toll. I'm the publisher of Private Equity Career News. I will be your moderator for the program. I'd like to start out thanking our sponsor, SBS by Bain & Company. They're an award-winning provider of actionable data and analytics for private equity firms seeking to optimize their deal sourcing efforts, and just a fantastic company. A few housekeeping announcements before we kick off the program. First, a friendly reminder to any reporters on the program today that we are off the record. Please reach out to the speakers individually for permission if you would like to use anything they say today in an article. Second, you can download a copy of the slides from today's presentation. You do so from the handout section of your control panel. You can also download a copy of the results of a survey of origination professionals that we conducted last year, and there's just a lot of really good, valuable information in there on industry-wide BD practices. Third, later today, I will send you a recording of the program, so no need to take extensive notes. And finally, thank you to everyone who asked questions when you registered for this program. We will plan to address those during the roundtable discussion portion. We also can take questions live during the program, and we'd love to get lots of questions during the program itself. And you do that through the question feature on your control panel. So I am grateful to have 4 expert speakers today to help guide us through the topic, starting with Nadim Malik, founder and CEO of New York City-based SBS by Bain & Company. Nadim is going to present statistics revealing the state of the M&A market out there, and also address the role that technology plays in helping deal originators see a higher percentage of relevant transactions. Today, we also have Steve Hunter. Steve is a partner and head of financial sponsor coverage for an investment bank, TM Capital. He's based in Atlanta. We have Nicole Kyriakopoulos, and Nicole is a director of M&A services at Align Business Advisory Services. She's based just north of Chicago. And we have Ashley Wenga, director of business development for McNally Capital in Chicago. Okay, so with that, we're going to find out a little bit more about our speakers directly from them. I am picking up a little background noise, so just a friendly reminder, if you're not speaking, to stay on mute. And of course, the noise could be coming from me, so I'll follow my own advice. Steve, tell us a little bit about TM Capital and your role there.
Sure, thanks, David. I'm Steve Hunter with TM Capital. I'm a managing director and partner. TM Capital is a middle market investment bank. We're primarily a sell-side advisor. We were founded in 1989, so we've been around for over 30 years. We have just under 50 professionals in 3 offices, New York, where we were founded, Boston, and Atlanta. Each of our offices is about the same size, so we have sort of 15, 16 people in each office. We operate in 5 or 6 industry sectors, depending on how you organize them. We have a good-sized industrials practice, consumer, healthcare, business services, which also covers tech for us, and then we have a chemicals practice. A typical deal for us is our typical year for us is 15 to 20 transactions. Last year we ended up doing over 35 or 36. So, sort of kind of a record level of activity for us. And our business is very evenly split between founder-owned and sponsor-owned businesses. And in that sponsor bucket, we also do a lot of work with fundless sponsors and mezzanine firms, folks that may have a sort of an outside interest in companies.
Thank you, Steve. And next, Nicole, tell us more about Align Business Advisory Services and what you do there.
So Align Business Advisor Services, we are a lower middle market intermediary. We provide both buy-side and sell-side services. We're industry agnostic, and we have a presence pretty much everywhere across the country. We like to focus on those businesses, around 100 million in revenue, 10 to 10 million. We see that as an underserved market. But our headquarters is in Winter Park, Florida. But like I said, I'm up in Chicago. So.
Awesome. Thanks, Nicole. And Ashley, tell us about your role at McNally Capital.
Yeah. Good to see everybody. My name is Ashley Kawenga. I'm the Director of Business Development at McNally Capital. We are a lower middle market sort of hybrid between family office and private equity firm. I don't know if anybody here recalls the company, the Rand McNally Maps and Publishing Company. It was owned by the McNally family for 160 years, owned through 5 generations of a McNally family member at the helm. And Ward McNally is a 6th generation family member, founded McNally Capital. So when they sold the family operating company, founded McNally Capital, and wanted to continue investing in family founder owned companies for the most part. So we're focused on companies sort of, 5 to 30 million of EBITDA across aerospace and defense, industrial products and services, and business services. And we also work with a number of other family offices as our primary investors, but also as our advisors. So we as a family knew everything about maps, publishing, and distribution, but to get the experience that we wanted and to develop various theses that we have launched in the marketplace, we work with our advisors across our family office network to help us do that. And the benefit of that is really that, all these folks have a family office because they've founded, built, and sold a company themselves. So they sort of walked in the shoes of the founders that, we're looking to invest in, that we're looking to partner with. So that's us in a nutshell. And we're in Chicago.
Nice. Thanks, Ashley. Okay, let me turn the baton over to Nadim Malik of SBS Bain & Company to introduce himself and to take him through some slides that will shed some light on the current state of the market. Nadim?
Thanks, David, and good morning, everyone. Really appreciate all our guests today. Hope everyone's enjoying some nice spring weather, and wherever you are, things are continuing to open up and feel more normal. At SPS, we're continuing to do what we do best, which is helping our clients position themselves for relevant deal sourcing opportunities in the current or any market using data, analytics, technology, and automation. Before turning things over to our expert panelists, I just wanted to spend 8 to 10 minutes walking through some slides to help frame our conversation and shed some color on the current market. So let's go ahead and get started with the first slide that you see on the screen here. Now that we're in April and the data lag for 2021 is pretty much behind us, we can see that closed deal volume towered past prior years at over 11,500 deals, with PE activity leading the charge, and it was up over 47% from 2020. And it was a year first. This was the first time we were above 10,000 deals. This was also the first time PE activity represented a higher share of overall M&A as it relates to corporate and strategic deals for the first time. So a really banner year for both private equity and corporate M&A overall. But did that trend continue in Q1 of this year? Moving on to the next slide, as of right now, Q1 is slightly below prior year's totals, but still the second highest year we've seen in the last decade. Now, we should keep in mind that given we're still in April, and there's going to be some data lag on deal announcements that come out after the quarter, I think it's safe to say that when the dust finally settles, this quarter might be the same, if not slightly higher than Q1 2020. Moving on to the next slide, that trend in prior years of the buy and build and roll-ups not only continued, but went crazy in Q1 of 2022 with PE firms completing almost 3 add-ons for every platform so far this year. I will be watching and monitoring this and curious to see if this trend continues as the year progresses. And I'd be remiss if I didn't use this opportunity to remind folks out there in the middle market and the private equity side, when you look at deal sourcing and business development and have a process and system in place for your platform acquisitions, it's a very different market if you're looking to help out your portfolio companies with their add-on sourcing. That universe of lower middle market brokers, intermediaries, which are often running below the radar processes in specific niches, are difficult to cover. And you can't apply the same strategy that you have for platforms for add-ons. And I think more and more of our clients and firms we talk to are getting more engaged with their portfolio companies, since in this crazy competitive market, that buy and build strategy is resonating more and more. Moving on to the next slide, private equity median deal flow in Q1 came in pretty high. In fact, it's the most we've seen for Q1 since we started tracking the data back in 2013. This seems to be consistent with what we were expecting in terms of, sell-side mandates and deals spilling over to 2022 from last year due to capacity constraints. And while this would suggest that we should continue to see robust deal closing numbers in the quarters ahead, frankly, I'm still not convinced, and expect overall closed deal volume to drop as we head further into the year. And I'd welcome our thoughts of our panelists once we transition over to the Q&A and discussion section of today's webinar. Moving on to the next slide, we often spend a lot of time gleaning trends and high-level takeaways and analysis from underlying data, but I wanted to emphasize the importance of customizing data and eliminating noise to get a clear as picture as possible, depending on what you're trying to achieve. Using the industrial space as an example, the left side of this slide, we start with a very broad screen covering all transactions in North America over the last few years, and then just drill down sequentially. And you can see how the number of deals and the focus narrows as you drill down first by sector, then by size range, then looking at deals only with intermediaries, and finally, those that went to private equity. And then you can get a 360-degree view of your market. Who are your key intermediaries and deal sources in that market, and what's your current mind share with them? Who are your competitors? Who do you run up against the most, and how are they originating deals? What are they doing? And of course, your capital providers and partners to help you finance your transactions. It's critical to know your ecosystem and get your perspective on key potential partners and peers, but it really needs to be customized, and you need to be able to drill in to your data to be able to do that. Moving on to the next slide, we have a lot packed on this slide. First and foremost, I want to point out the number of active sell-side intermediaries that we identified in 2022. I wondered if an increased deal volume like we saw last year also meant that there would be just more bankers and brokers, or just that same typical number of bankers and brokers doing more deals. Well, I can tell you 916 is the most intermediaries we've seen in any year, and that compares to 791 active intermediaries in 2021 at the time we generated these stats last year. Then moving to the right side of the slide, you can see the most active sellers to private equity buyers. These are probably well-known firms that most people on our call today would recognize. They're typically running broad processes. But if you shift your focus back to the left side in the subheader of the title, after you get past the most active firms, 68% of the 916 intermediaries closed 3 deals or less. And these are often below the radar, quieter processes where if you don't have a strategic, proactive, data-driven, efficient way to penetrate that, you might be missing out on some attractive opportunities. And then moving further down the slide, of those 916, 160 sold a business for the first time in 2021, and 270 that were active in 2020 didn't do a single deal in 2021. So that's a total churn of about 430 firms per year, and not to mention people, which would be some number or multiple higher than that. And just to get some perspective, what that means is every day, multiple things have changed or occurred in the deal sourcing and intermediary landscape for your target market that in an ideal world you'd like to stay in front of. And so it begs the question of how often is a cleanup exercise of contacts and retiering good enough when every day, things are changing. I can tell you that with the SPS platform, we send our clients alerts every week, making them aware of any new intermediaries, people as they've left firms that can really help with this process. Moving on to the next slide, knock on wood, if things continue to progress positively, then travel is going to be more of a thing in 2022. It already feels like it's become a huge thing, at least for my interactions with our clients and peers and others. Feel like everyone has been on the road in March and April, and that trend is going to continue. But you need to know where to go, and you need to be smart and strategic. You can't be everywhere all the time. And the intermediary landscape, as you could tell by the previous slide, it may have shifted. New firms have come up. Professionals have changed locations and firms. In the SPS portal, with a few clicks, you can generate a heat map that looks like this. And it could be created in a few different ways. It can be created where the intermediary professionals and deal sources are located that are doing the deals in your market. If you're a lender or an investment bank with a sponsor coverage model, it can show you where the private equity professionals are located doing deals in your vertical and size range. Or it can be where the targets and private equity assets are located to identify them directly and be triangulated with some of these other cuts. And so it's very important to be able to drill down at a macro level, and then of course, plan a trip. You can drill down to a city view. Once you're in a market, our mobile app has a geospatial ability that you're either going to love or find very annoying, in that, let's say you have a lunch cancellation and you're in South Carolina, and your mobile app will show you, David Toll is in this building or right around the corner. Let me see if he wants to grab coffee or lunch. So great way to fill that last minute meeting with the mobile app. And finally, moving on to the next slide, I'm very excited to share our latest product development. Our parent company, Bain & Company, which is the top consulting firm to private equity firms, has developed a proprietary industry taxonomy from its work over the last few decades consulting private equity firms. And we have gone through our 90,000 plus database of private equity and M&A deals and restated those deals with this new taxonomy and are applying it on a go-forward basis. It's 560 subsectors deep and rich, and we're very excited about this. It is a real game changer. If you understand this type of data, have looked at this type of market, one of the frustrations is, you can end up spending a lot of time to whittle away the noise and really figure out the deals that may be relevant to a particular strategy or buy and build. And a lot of the industry taxonomy that's out there or common can be very challenging to achieve that. So, and what good is all that volume of information if you can't cull it for what you're looking for in a very quick manner? So we think this solves a real problem. And over the next couple of months, we're going through the delicate and detailed process of rolling this new taxonomy into our UI for our client-facing portal, and then applying it to all the data sets that our clients monitor very carefully that they consider relevant. So with that, I'd like to turn it back to our moderator, David, and our panelists for our discussion and Q&A.
Oh, thank you very much, Nadim. Say, Nadim, I was curious about your prediction that even though Q1 deal flow was at a record level. You still anticipate the deal volume in 2022 will be down from last year. What's your thinking there?
You know, I was thinking about that, David, and I think we were all expecting Q1 deal volume to be high, at least from the messaging that we received from investment bankers. Between deal fatigue and capacity constraints and all the forces at play that made 2021 so robust, you know, if you were deciding to come to market as a seller, I don't know, Q3 or Q4, there just wasn't an opportunity for you to do that. So I think we are seeing a lot of that spill over to this year. You're going to see that translate into a higher closed deal volume in Q1, in Q2. But I do think once that backlog of deals is behind us, and you look at the year that we had last year and the forces in play, I just don't see those forces at work. So, but we'll find out. You know, stay tuned. Let's see what Q2 deal log looks like. Let's see what Q2 closed deal volume looks like. But I'm sticking with my prediction that it's going to decline as the year progresses.
Okay, thanks, Nadim. So with that, I'd like to take advantage of the fact that we have a really large audience today to gather some market intelligence with a handful of polling questions, and after that, we'll get into the heart of our discussion. So my first polling question is what percentage of the time do you expect to be on the road this year? And I'll give you another 5 seconds to answer this. You can pick 0 to 10%, 10% to 25%, 25% to 50%, or more than 50% of the time. All right, I closed the poll and I'm going to share the results. All right, having some technical difficulties with the polling, but I can see the results, so I'll just share them with you. 44% of you, and that's the plurality, picked 10 to 25% of the time on the road. So 10 to 25% of the time on the road is sort of the number one choice. 0 to 10% was the second choice, second most popular response, about a third. Then 25% of you picked 25% to 50% of the time on the road, and very few of you are going to spend more than 50% of the time on the road, about 3%. Okay, since we're having some trouble with the polling technology, I think I'm not going to press my luck, and we're just going to go right into the discussion portion of the program. So let's start with the question of deal flow, kind of segueing from Nadim's presentation. And we'll start with a really big question of just how is deal flow out there right now, and what are the big motivations for sellers that you're seeing to come to market with companies? And I'm going to ask each speaker in turn to address that one. And we'll start with Ashley.
Great. First of all, can you hear me? Did my mute button work this time? All right, good. Yeah, so I was so happy to see Nadim's numbers that were slightly up first quarter over last quarter, because I was just looking at our numbers this morning and we're roughly the same. We're about 5% up total deal flow from first quarter of last year. But definitely seeing mixed quality in that. I think that's something a lot of folks have been kind of saying, but we're definitely seeing it. Just maybe some lower margin business, maybe stuff with high CapEx. We saw a company that, you know, one piece of the business, the assets were all owned by one entity, and the other piece of the logistics was owned by another entity. And so it's just very complicated structure. And so we're kind of all scratching our heads like there's all this deal flow, but it's just a little bit mixed in terms of quality. And I think, you know, kind of again, piggybacking off of what Nadim said and just agreeing with his comments, that you know, last year was so busy, and a lot of the quality platforms came to market last year, right? There was a lot of stuff going on. We had COVID fatigue, we had capital gains taxes, right? All the things we know about that pushed all this deal flow to happen in 2021. So it's almost like you're kind of right now seeing a lot of companies that couldn't come to market because they were of lower quality and they weren't necessarily going to get the attention. So that's just something interesting that we've seen. There's still good deals out there, but it's just we're kind of sifting through more. Obviously, those coming from the likes of TM and Align, my colleagues on the phone. So yeah, so I think the rest of the year it's going to be like everybody kind of said here. We'll just have to see what happens. We don't have some of the same catalysts that we had last year. Now we're dealing with supply chain issues, and you know, we're dealing with inflation and potentially, you know, increasingly rising interest rates. So we're going to kind of have to see what the year unfolds, but I certainly don't think anybody expects it to be as big as 2021, which is fine, and that's normal. Let's just hope we can get some deals done.
You're here, okay, and let's go to Nicole. What are you seeing in terms of deal flow and motivations from sellers?
Yeah, so Q1, we did have a slow start, January and probably mid-February. Seems like it took some time for the buyers to digest and kind of get their bearings from the very busy 2021. But then starting in mid-February, we did start to see a pickup, and now we're pretty much seeing to the same pace as last year. Some of the motivations that we're seeing is I think there's a lot of sellers out there that are, you know, listening to the grapevine, and they're starting to hear what some of their peers might have received last year from a valuation perspective, and potentially hoping that they didn't miss their opportunity to take advantage of higher valuations. So that's something, and most of the clients that I've been talking to, they're kind of in the low to mid 50s in age range, and I think they're just starting to look for, you know, what their path to retirement is going to be. So that will always be in existence regardless of the current environment. But yeah, that's kind of the profile that we've been seeing. You know, I think just the clients that were kind of not sure about, you know, last year, the potential sellers are now, you know, reaching out to us and thinking that perhaps this is the year to consider it so that they don't miss out.
Okay, and Steve, how about you? What are you seeing?
Yeah, I would echo a lot of what my other panelists have said. I think I think there's a couple different ways to look at it. Obviously, everybody was so busy at the end of last year trying to get everything done that there wasn't a lot of business development, sort of new deal sourcing going on in the second half of the year. On the investment bank side, everybody was fairly busy. So what we took on some mandates then with the idea that we weren't even going to touch them until January 1st. So when people talk about deal flow being down, you know, our backlog of active deals is higher than it's ever been, even higher than it was last summer. We have probably close to 20 deals that we're bringing to market, and that wave is really starting to crest right now. We launched 2 deals this week. There's several more launching next week. And I think it was just a function of nobody really got started on any of these deals until, you know, probably the second week in January, and then you had to get Q of E lined up and you had to sort of get it. So I think people will be pleasantly surprised at the volume of deals that are coming to market in the second quarter. In terms of what gets done, I literally in the last week or two have started to pick up a lot more concern and caution and even negativity about the second half of the year. There's been a lot of companies that were really bent, and I think there's 2 things going on there. One is you've got some companies that were doing really well through COVID, companies focused on like outdoor, backyard, you know, e-commerce type businesses. And so you have the trend of people getting back to work, and some of those businesses are seeing some softening. Netflix, you know, was the big example yesterday. And then at the same time, you do have some economic concerns out there. You know, interest rates are ticking up. People are getting a little cautious. I think what's interesting is, you know, it's a fact that the U.S. is completely underbuilt from a housing standpoint, but everybody still has so much scar tissue from the meltdown in the Great Recession that everybody still thinks that housing is, you know, going to be one of the first things that gets hit. So I think I think it's I agree with Ashley, but I think it'll be a challenge to get back to what we did last year. But based on our backlog, we should have a better year than last year. But I think some of the stuff's going to fall out.
Nice. Steve, wonder if you just continue a bit with the specific impact that the rising inflation, rising interest rates that Ashley mentioned are having on sort of just the due diligence process and the prospects of company performance this year.
Yeah, I would say that I think it's impacting the M&A market in two ways. One is the impact it's having on the consumer. So I think a lot of the concern out there is that as interest rates rise, does that cool off the real estate market? Does that cool, do people have adjustable rate mortgages that are going to reset? Is the consumer going to start pulling in, and that's going to result in, whether it's less spending on home improvement or less spending on cars or whatever. So I think that's one piece of it. I think the other side of it is it's created a lot of additional work and analysis and confusion in companies' numbers because of the impact of inflation and supply chain issues on their cost structures. So we have a lot of companies that were paying exorbitant freight charges to get product in 2021. Whether it was air freighting things that normally would have been shipped by boat, or companies that were selling product but couldn't have it installed because they couldn't find labor, or even in terms of inventory, where there are a lot of businesses that came to market where, as the private equity firms were doing diligence, one of the things they were really looking at is, okay, is this company just making more money because it's selling inventory that they bought a year or two ago and it's now worth 30 or 50% more because of all the inflation we're seeing. So I think those are the things that we've seen. I think the other part that's really tough to pin down is just the level of uncertainty that inflation creates. No one knows what your costs are going to be next quarter or next year, and so I think it's definitely added a layer of uncertainty, but I think it's just causing people to do a lot more diligence and a lot more work around cost of goods sold and the add backs that you might have in a quality of earnings report.
Got it. Thanks, Steve. And we did get a couple of questions from the audience, and I want to address those now while Nadim's presentation is fresh in our minds. Nadim, on the taxonomies that Bain & Company and you are introducing, are those going to be sort of fixed for all time, or is there some element of evolution built into them so that they can change as markets change? What I think I'm getting at the heart of the question.
It's a good question, David. If you asked our team, our IT team, and our analysts, we'd prefer that it gets fixed and stays fixed for a long time, because just adding a few new intermediaries and subsectors requires restating, and looking through potentially thousands of deals, and then the UI can be quite significant, even adding a couple of new verticals. But no, it is going to be dynamic. It is going to evolve as the markets evolve. It has been a product of decades of work that Bain has done. So it has gone through various iterations, and so it's not going to be a drastic change, but yeah, there will be new. We just recently added a few additional verticals and all that. So it is going to and has the ability to evolve over time.
Okay, and Nadim, also a question for you is, how are sponsors and others leveraging AI for deal sourcing? Can you speak to that with your own platform?
Yeah. So before I get to our own platform, I think I would just comment on the market. I'm hearing more and more across the spectrum, from smaller funds to the largest funds in the world, recognizing that AI, predictive analytics, all sorts of automation, whatever you want to call it, are going to impact various kind of sectors of the economy, the businesses they invest in, but also private equity. And so we've seen a lot of firms bring on data scientists, AI experts, teams, and frankly, over the last 3-4 years where we've seen this trend emerge, I think there's a recognition that something needs to be done, but I haven't at least come across a strategy or a cohesive game plan on how, true AI and predictive analytics can come into, like, for example, private equity deal sourcing and optimize. Now, it really depends. AI is something that's used pretty loosely sometimes, and whether it's our platform or some other platforms out there, if you're talking about technology creating efficiency, things like predictive behavior by analyzing the market and see where it's going and trying to predict where things are going, whether it's through alerts or an ad hoc analysis or any one of our features, and most of all, saving of time to help direct your efforts. Now, those are all benefits of technology and efficiency, and they give you an edge. But I would say it's just like the foothills of the vast potential mountain that is AI, and I think we're very much in the early innings here.
Ashley, any thoughts on the application of AI to your own internal deal sourcing efforts there, and what the future might look like?
Yeah, for sure. I would love it if somehow I could leverage technology to reach out to all the world of deal sources that we need to reach out to at the exact right time when they have a deal that's coming to market. So if we get there and continue to get there, that'd be great. I think that's probably a long shot, but I think more, again, to what Nadeem was saying on just the efficiencies piece of it, there is a lot of administrative kind of stuff that you can leverage technology and leverage sort of AI in your process and your flow that can definitely make you more efficient, and also help you find your targets faster. So any little thing that makes you bigger, better, stronger, faster, even if you're not directly predicting the future, is definitely helping. And there's little, I've seen it, just, of course, we've all seen it in our various roles over the last 5-10 years. It just continues to accelerate. So I expect that we'll continue to have, better tools as we progress, right? So I think at some point we will all sort of, be using a lot more technology, even more so than we do today. But it's still growing, and there's still, at the end of the day, got to be human-to-human contact to get things done. So.
Got it. Okay, let's switch gears a bit and get back to sort of market conditions. And I want to turn to Nicole and ask about the state of the credit markets, and just describe sort of the availability of credit out there, and on what terms, and how the financing markets are looking.
Yeah, we're still seeing availability of credit is still there. Of course, rates are rising. From a historical level, though, we're still close to all-time lows, so that it's probably not going to be a huge impact in the near future. However, I do think credit, while it'll be available, the cost of credit will start to eventually flow through to valuations as it hits the costs for the sponsors. So that's kind of just a high level opinion.
And Nicole, on the size deals that you're working on, and I think you mentioned these are companies of revenue of $10 to $100 million or so. What kind of leverage multiples are kind of possible at that portion of the market?
I'm not really sure as to the buyers that we've had have typically not disclosed that. As far as selling multiples, it's too broad of a range probably for me to provide an intelligent response on that.
But the leverage is there.
The leverage is there, yes.
For deals of those size.
I'm currently going through one that is going to be more levered than I've been exposed to in the past, so I'm curious to see how that fleshes out.
Nice. And the other thing I'm curious about is just what's going on with deal prices. Ever since we started doing these webinars 3 years ago, it's been nothing but higher and higher valuations for companies. Actually, any sign of a cooling off in prices with everything that's going on in the world today?
Absolutely not. No sign of cooling off anytime soon. I think the reality of it is, rates were just increased in March and only by like a quarter point. So we're just not really seeing that rise in rates yet. That's hitting the credit markets yet. That's impacting our valuations to kind of come down. So, again, let's hold this panel again in maybe 2-3 months and see kind of where we're at. But even then, I mean, so we're still in the same situation where we've got, I think it's like 1.8 trillion of dry powder in private equity, and we're all chasing the same deals. I mean, private equity as an asset class has, 20 to 25% IRR, and you compare that to the public markets, which is probably something like, 10, 11%. So capital will continue to flood into this asset class. I mean, we're an attractive asset class, and that's what we've been seeing. And until those margins become compressed, right? And this is what happens across any industry. We're going to continue to see interest in this market, in this asset class, and that's going to continue to drive competition, and we're going to see prices continuing to be high. So unless something changes with the Fed funds rate and policy, that sort of manually changes all of that for a certain period of time, I think the fundamentals of private equity are still going to drive frothy valuations.
All right, actually, we got a question from someone in the audience, sort of back on the credit markets theme. And can you speak to the availability of credit for your deals, and particularly how much you rely on unitranche financing as your primary debt source?
Yeah. So again, credit is still very available as of today and as of this point. So that's good news for us. In terms of the structures that we use, we're investing in a lot of companies. I mean, our sweet spot is sort of 5 to 12 million of EBITDA. And so, the smaller the platform, we don't want to overburden our companies with too much debt. So unitranche is something that we would use, I think, for a larger transaction where we could go deeper into the capital structure and feel comfortable with that. And of course, as the valuation multiple, gets higher for a larger business, you want to continue to sort of support that valuation. But for smaller companies, we'll just still continue to use senior debt financing, which is still, very strong. We're not having to dip into mezz if it's a smaller business. So, but I mean, as far as I know, the unitranche market, if you're a 10 million plus EBITDA business, I think unitranche is fairly standard practice at this point across the market.
Nice. And just a follow-up question for you, Nicole. What deal sizes do you usually bring to market, I guess, when you're selling companies?
Yeah, it's so anywhere from, $1 million in EBITDA to, 5, 6, 7 million in EBITDA is where our clients are.
Okay. Let's turn to another big question. All of our speakers today are generalists generally speaking, roughly speaking. So they cover a lot of territory. And what I would like to know is, what are the particular subsectors, maybe one or two, that each of you could point to that is just particularly active right now, and you're seeing a lot of sponsor deals, and tell us what the subsector is and what's going on. Why are we seeing so much activity? And Steve, I'll start with you.
Sure, thank you. I think, I guess I would say a couple things. I think you're gonna see a rotation away from things that are exposed to the housing cycle. So some of the building products, things that I think people feel are interest rate sensitive. I think you're going to see people, not necessarily that those deals aren't going to come to market, but I think there's going to be less interest in them, and valuations will probably take a hit there. In terms of areas we've seen, I would say one continues to be e-commerce. We've done several really interesting e-commerce transactions for both companies that were founded online, that were we call them digitally native businesses that that started online and have grown to be sizable in 3-5 years. We continue to see great examples of that. And I would say the other is I think you're going to see kind of renewed interest in healthcare and food as people look for more recession-proof type areas. I think healthcare the last couple of years has been a little chaotic with COVID and its impact on the healthcare system. But I think as we go forward, I think people are going to be looking at healthcare as an area that is kind of a recession-proof safe haven. So I think the other area we've seen a lot of activity, but people, it'd be interesting to see how long it keeps going is in the HVAC world. There's been a lot of both. I think the real crazy frenetic activity has been on HVAC services companies. The technicians that are coming out to your house or your building to do work. The multiples there have gotten into sort of the high double-digit EBITDA multiples for even for smaller businesses. And so I think people are frustrated. There's obviously a lot of opportunity there, but people are getting frustrated with the valuations in that area. And then I'd say the other is where we've seen a good bit of activity is in HVAC distribution. So not the technicians, but the firms that are distributing the HVAC equipment that the technicians are using. That's another area where we continue to see more and more activity. Thanks,
Steve. And Nicole, I know you're also seeing a lot of HVAC deals. Tell us feel free to add more color on that and tell us about some other areas that are hot.
Yeah, so I still see a lot of activity in the HVAC space, as as was mentioned earlier, is that the multiples are high, and however, I think there is a lot of opportunity for other HVAC, maybe ancillary services, such as industrial insulation that is tied to HVAC. So there could be side services that are still involved in HVAC and building services that could potentially start to come to market more. As far as other industries, of course, we're seeing healthcare, outpatient services, and then back to facility services, waste management, home services are still in high demand from a sponsor perspective. I do think some sponsors are getting more creative in what they're looking for, maybe getting a better understanding of the construction mix in revenue, and maybe not demanding that it's 90% service in order for there to be an interest in that a specific company. So there is a lot more coming to market, but there's more construction heavy on the HVAC side.
Got it. And Nicole, any areas ostensibly cooling off right now that aren't as hot?
I haven't seen any specifically. My focus so far, just because of my background, has really been in HVAC and industrial services, waste management, just because I came from corporate M&A in both of those. But so it's kind of where I'm sitting now. I have not seen a cooling off in where I'm focused, and I have not heard anything really, unless there is something that's extremely impacted by, economic factors. Otherwise, there's really hasn't been too much specific that I can talk to.
Okay, and Ashley, I'm curious if you're trying to zig while others are zagging, or exactly what is your investment philosophy right now in terms of new deals?
Yeah, we're zigging and zagging along with the others, fortunately or unfortunately. So we just bought an HVAC platform about 6 weeks ago. Smith & Obi just closed. So it's interesting to draw parallels, because I used to be a lender exclusively to healthcare companies maybe 10 years ago. And so I saw sort of those early days of multi-site healthcare, right, flock to that as sort of a safe haven, but also a great place. There's a great value play to be made there, where you can kind of buy and build and draw synergies from it. But back then, a dental platform or a derm platform, a really high multiple was 10 times. And now 10 years later, that same platform goes for 14, 15 times, et cetera. So to kind of see those parallels in HVAC and other facilities management, right? We're getting there too. That's where platforms are trading today. But I think the reality is, groups like investing in these types of sectors, there's a lot of key themes, right? Healthcare, no matter what's happening with the economy, for the most part, is going to be, recession proof, right? Similarly, if your HVAC system breaks down, you're still going to call a tech to come in. It doesn't matter if there's a recession, you need heat, you need air. If you have an entire commercial building, that goes down, that stuff needs to be taken care of through thick and thin, if you will. So, I think there's just, again, some fundamentals within those particular types of industries that are always going to keep them strong. They'll see dips for sure. If the broader market dips as well, but just not as much. So we're seeing a flock to that quality, and we agree with it. And so that's why we've invested in an HVAC platform.
Okay. Let's move to the, well, first let me just remind everybody, since we've got about 20 minutes left in the program, we want to get to all of your questions, so please avail yourself of the question feature on your control panel and fire away. The next question I want to like to stick with Ashley, and there's always a lot of interest in just how different family offices and private equity firms go about finding deals, and what's your process. So I wonder if you could take us through the basics and maybe highlight anything that makes your deal sourcing effort unique, maybe because of family office connections that you have, Ashley.
Yeah, for sure. So the reality of it is deal sourcing kind of wherever you are, because it's not so much about who we are, but it's about what deals we're trying to source. And so if you're trying to buy companies, you have to be attractive as a buyer to those companies, kind of whether you are a family office, whether you're a private equity firm, whether you're an independent sponsor, et cetera. So deal sourcing, it can look very similar. I think the key, and this is what we strive to do, and a lot of people say this, right, is to differentiate yourself and find your niche, and find what areas of the market where your story resonates best. So we've spent a ton of time developing different theses, right? It's no longer, it doesn't work anymore to have a general story and just develop a relationship, because the target you're talking to, whether it's directly to a company or to a Nicole or to a Steve who are representing their clients, there's 10, 15 of us that are interested in buying that company. And so just sort of we have a relationship, and, we have these resources as a sort of general sort of starting point for private equity or family offices, whatever you're bringing to the table is no longer really enough because it's so competitive. So what we've spent our time doing, and this is it's a BD strategy, but it's really a firm-wide strategy that supports BD, is to make sure that we're finding subsectors of interest where we know that we can differentiate, where we think there's strong tailwinds and for growth within that industry, and then we become experts, right? We also partner with industry partners from our family office network, because you really kind of want to have that story that you can take to market, where Steve or Nicole, and Nicole, we have an HVAC platform. She works with HVAC companies all the time that would be added on. We have to really express to Nicole, how are we different? How is our platform different? Because Nicole needs to take that to her clients. So that's really the strategy, is finding your spots and finding what your story is and going with it and delivering that message to the marketplace. And then, of course, using technology to round that out. I use SPS almost every single day. How did I find Steve and Nicole to develop a relationship with them? Steve does a bunch of industrial deals. Nicole does a lot of HVAC and other facilities management deals. I went into SPS and I found them through SPS. So that's how I'm able to say, here's the firm strategy. Now, how can I most quickly get out to market and find intermediaries that are a fit for us, right? And to be totally honest, when I first started, I was like, I can just Google this. I'll find a couple conference lists and I'll go through tombstones, and those were hours of my life I'll never get back. And then I found SPS, one of Nadim's colleagues, reached out, and I talked to a couple people about it, and it was kind of like, you know, at the click of a button, I was able to sort of find those intermediaries that were a good fit for us. It saved me a whole bunch of time, which was really great. But yeah, so our process is starts with firm strategy, right? Making sure we're targeted, making sure we're focused, making sure we're being smart. And then from a BD perspective, it's crafting that story. And then of course the marketing materials and the outreach plan and using tools like SPS and our Salesforce to keep ourselves organized to go to market quickly and effectively.
And Ashley, on the communication front, just that effort to get your story out and the way that you're differentiated and what you're looking for. Anything new under the sun there in terms of using social media, TikTok? What's working?
I have yet to do a TikTok video, so I kind of think, I hope I want to keep it that way. Yeah, I mean, I think we definitely start with the fact that relationships are built in person. So at the end of the day, we want that in-person touch. You know, we want to talk to people. We want to get to know them. We want to build that relationship. That's the only way on top of that where we can truly express our differentiation, right? Giving you a full rundown of who our experts are that we're bringing to the table. When you shake those people's hands, you know, that's when you can really learn about each other. But starting at a high level, you know, we're doing email blasts for sure. I think everybody on this panel is on our email blast, so hopefully you've got the one that we sent out last week. Another one's coming out tomorrow. That's a great way to sort of hit a broader audience. I usually get some good feedback from those, and you know, making sure that it's all consistently messaging who you are and what your differentiation is, right? And sort of continuing to kind of push that story into the marketplace. I will, quite frankly, I don't use a ton of like those LinkedIn, like where just mass messages go out to a whole bunch of people. I haven't really thought about that yet because I want to be able to control it better. I don't want it to feel robotic. So and quite frankly, I'm one person who manages deal sourcing for us. So I'm sure I could get there if I spent that time doing it, but I haven't seen that that's the case yet. And so what I want to avoid is yes, we want to use tools, but we don't want to turn into the tools and the robots that the tools are, right? We still want to make sure that we're giving it that personal touch.
And Ashley, you said just no replacing that personal interaction that you have with folks. How much time do you spend on the road these days?
Yeah, so it's interesting. I started in May of 2020. So I don't have a sense of what a traditional BD role is like, you know. So for me, I joined the world when it was the COVID world. So we weren't traveling at all, but now we're definitely starting to get back out on the road. And so I want to try and be out on the road, you know, once a month, maybe once every 6 weeks, just to, you know, be seeing people, going to conferences and just kind of getting our name out there. That said, I definitely think this panel that we're doing today, this is fantastic, right? And my ability to video call with Nicole and Steve and others, right? We don't have to, you know, hop in the car and drive or, you know, hop on a plane every single week like we maybe used to. At least what I've heard is what we used to do. And back in my prior life is what we had to do. So I think we're getting back to traveling, but call it, you know, once every 4 to 6 weeks and maybe not every week like it was before.
Okay, so thank you, Ashley. With this final 15 minutes or so, again, kind of last call for questions. Please, if you have questions for us to address, go ahead and ask them now. So we'll take the balance of the time to address those and also just give you our best practical tips for improving relationships with deal intermediaries, finding proprietary deals. And Nadeem, I want to start with you because you see the whole market and you gather data there on the market. Can you give attendees a sense for what percentage of deals are truly proprietary these days and don't have intermediaries associated with them?
Yeah, David, to answer that question specifically, It varies from deal type to deal type. So what do I mean by that? If you're a private equity firm doing deals of 30, 40 million of enterprise value and greater, according to our data, at least the vast majority of the deals you're going to do have a sell-side advisor involved, are not proprietary. But on the other end of the spectrum, if you're doing small small deals and it's a corporate to corporate deal, our stats show that market, sub 50 million of EV, when both buyers, there was no private equity involved, both prior, about 75% of those don't have an intermediary. Only 25% of those are intermediated. So it can vary pretty broadly. And I like building a little bit on what Ashley was saying. How do you differentiate yourself and all this competition? We've seen a lot of not only sector specialization, but subsector specialization. And going back to your earlier question, David, we've seen a proliferation of growth funds that have come up, doing smaller deals. And when you think of the VC to private equity LBO spectrum, there's that gray area in the middle. It's call it late stage VC or early stage private equity. Could be minority, could be control, but that late stage, that kind of growth fund area is an area we've seen a ton of new funds popping up, and they're typically they could be technology or software oriented, broadly speaking, but we've also seen some amazing subsector niche specialization in these funds, whether it's healthcare technology, whether it's cybersecurity, whether it's data and information services only within that. So I think there is becoming a greater trend to get that not only sector, but in some cases, subsector specialization, and funds are successfully able to deploy capital, and not only deploy capital, but raise funds because of LP demand in that area too. So just wanted to share those couple of observations.
Thanks, Nadeem. And we got a question that came in. What tips do you have for improving relationships with intermediaries and staying top of mind? That sounds like a perfect one for Steve and Nicole. So Steve, I'll start with you.
Yeah, I would say, it's a lot of the things that Ashley was saying, sort of keeping in touch on a regular basis, letting us know, what your, a lot of times firms will be working with executives, and a lot of times if you happen to catch them right when they've started working with an executive and the deal you're working on is a good fit, that can work really well. So keeping us very up to date on kind of what the hot areas are that you're most interested in. A lot of times, if a firm's done a lot of work and come in second on something, they'll have an interest in a deal if it happens to line up with all the work that they've just done on something else. So keeping us in the loop, I think from our standpoint, it's really helpful when people operate, the people that are calling on us are not just marketing people, but they're really plugged into what's going on at their firm. And they can tell us, if we have a question about one of their portfolio companies, they don't just say, oh, I don't really know, I'll have to get back to you. But they really know their own portfolio inside and out. They know which partners were working on it. They know, would it make sense for my business services banker to call that partner? They'll say, listen, they can tell us whether that's a waste of our time or a good use of our time or not. But they're the way I think of it is that they're a value-added piece of their firm. They're not just a marketing person. And so I think using that and the in-person visits to really try to build relationships is really helpful, because it's gotten so crowded. I mean, we use Salesforce to try to keep track of everybody. We're constantly updating it. As Nadeem was saying, there's so much movement. He was talking about movement on the advisor side. I think there may be even more movement on the private equity side. The number of fundless sponsors that pop up each week when, partner A leaves, big firm X and sets up his new firm. You have partners from a lot of the large buyout funds setting up their own family offices. So it's a real challenge for us to keep up. So I think it's trying to find this nice balance between keeping us up to date and informed and in the loop, but at the same time, not just, spamming us and calling every week when there's not really, there aren't updates week to week. So I think it's trying to strike that balance. And so, the people that I really have formed good relationships with. It's a two-way street. If if they need information and they're trying to find something out, they'll call me and I can try to help them. If I'm looking for information on something, I know I can pick up the phone and call them, and they'll help me get smart on an area if we're trying to get smart for something, for a presentation or a pitch.
Okay, so be sort of a trader in information. That's
Or a good
one
partner.
of
It's a two-way street. It has to be there has to be some give and take. It can't just be, hey, I'm with this firm. Tell me about all your deals you have coming up. There needs to be something. There needs to be something the other direction.
right. Nicole, what are your top tips for building relationships with intermediaries like yourself?
Yeah, I think just to add on to what Steve said, I would definitely just, pick up the phone, schedule a coffee, a lunch, get to know your intermediaries and just so that we know the person behind the firm, behind your fund. We are, constantly trying to put a puzzle together with our clients and what the ideal buyer could be from a personality perspective, the items that you can't see on paper. And Ashley and her firm, they are fantastic at that. We've had lunch, we've had phone calls. Ashley sends, hey, how are you doing? Even from a personal level, how did you do from COVID? And she really grasps that personal approach. And like, I know that firm just on a personal level, just because we have had the coffees, the lunches, and gotten to know them. And so when I come across a client that I can see their personalities would mesh well, I'm probably going to reach out to McNally to see if they're interested. And then also just knowing exactly what a firm is looking for, because we are, we're like, hey, I had coffee with a potential client. They were not ready for a process now. But then if I meet a sponsor that they seem would be perfect, we can make that connection. So I just think really there's nothing fantastic or special about it, but just really taking that time and investing and building those personal relationships is, I think, my biggest recommendation.
Okay, that sounds like great advice. And a question just came in. I'm gonna give this one to Ashley. To the extent that you have a different deal sourcing strategy for platforms versus bolt-ons, say micro market bolt-ons, I wonder if you could describe the strategy that you use to find those small bolt-on acquisitions.
Yeah, great question. So, yep, you have a whole strategy for platforms, but then when all of a sudden you're looking for add-ons, that can change pretty dramatically, right? When we're looking for platforms, our intermediaries that we're in touch with typically cover a certain size range, and now those folks are no longer going to be able to help you with add-ons because they don't cover smaller companies. So you definitely, right, as a starting point, it's just making sure you're finding the right audience. And again, I just go back to SPS as a tool. That's, for example, for our HVAC platform, right? It was sort of narrowing down our search list of, okay, who are the intermediaries that are covering some of the smaller HVAC companies? Because those are going to be, and even just smaller companies in general, because even a generalist in any given market can come across their local HVAC company. So while we might be focused on a certain subset of intermediaries for looking for our platforms, we sort of shifted gears and said, hey, what's in sort of the lower middle market where we know that these intermediaries are going to be covering our add-ons. So we're doing that. We also use buy-side firms. We have not implemented one yet for our HVAC platform. We just bought it 6 weeks ago, so we got a lot of planning that we're working on. But I think that that's a really effective way to, right, especially when you're a small team and I want to dedicate my time to sourcing platforms and additional platforms. So, I'm not going to necessarily all of a sudden start going to every single HVAC conference and trying to source all these add-ons. It would probably be best if I outsource that to another group. And I think if you're from a larger fund, you maybe have more resources and you could consider doing some of that work in-house, whether it's finding intermediaries or doing proprietary calling. But our strategy has just been, hey, we have only so many resources. We kind of have to pick our spots. And so from an add-on perspective, I think that, a buy-side firm can be very helpful.
Okay, and with just a couple of minutes left, we're going to wrap up with a question for Steve and Nicole. And this has to do with once the process for a company is actually underway, and everyone's jockeying for position, what's your best advice to sponsors that are looking to get an edge in the auction process beyond just outbidding everyone else, if that's possible? And go Steve, Nicole, and
Okay.
go ahead.
Well,
Steve.
they can always just pay more than anyone else. That is always an option. We're not opposed. We're not opposed to that. I would say that it's probably really investing the time to understand what the client is looking for, and in that case, it really matters a lot who the seller is. Like, so if it's the seller is a family-owned business, there may be things that are important to them that may be non-financial in terms of roles after the transaction or the fit with the firm. Like if it's a company that's really worried about legacy issues, maybe someone like McNally's a great fit because they might own the business for a long time and they like that family aspect. It's a little more challenging if the seller is a sponsor, because in that case they really are, we're being pushed on behalf of our sponsor clients. They all like to be friendly with their management teams, but at the same time, they are really only looking at sort of what's price and price only. So that's the it is more challenging on that. But on the founder side, I think it's really trying to understand what his motives and objectives are, or his or her motives and objectives, trying to give examples of where they've worked with similar businesses to be a good partner like that. And in that case, that can account for something more than just dollars. If there's a if the founder just likes someone better, he can choose someone. They're not going to leave a lot of money on the table, but it may give somebody a benefit on the margin. But it's really trying to show how you could be a good partner, not that you're just another financial group.
Right. Nicole will give you the final word. So advice on edging out the competition without necessarily paying the highest price.
Okay, I think in the lower middle market where we live, what's important most to our sellers is really to understand that path forward. What life is going to look like day 1 after close, day 30 after close, day 90 after close, and really kind of what your vision is for their business. A lot of these sellers in the lower middle market, it is their their brainchild, their baby, that they graduated high school and just started this business, and they want to know what's going to happen to it. And showing even that path forward to obtaining the second bite of the apple. If they're requiring a reinvest, they want to truly understand what that looks like and what they need to do in order to achieve that second bite. That's really where most of my clients get hung up and want to know. And it seems to be an area where it's kind of lacking. It's just kind of very like, oh, well, there's the second bite concept, but no one really understands how to get to it. So I think that would be very helpful in letting the sellers envision what life with you would be like as a partner going forward.
David, one other thing I thought of that I think can also help is really just being very forthright and open and communicating with the advisor, with us, and sort of saying like, listen, this is something we're really serious about. Here are the things we're doing, behind the scenes. We really want to prevail here. Because I think a lot of times, we know that all these firms are looking at a lot of different deals, and there are firms that just throw offers in to try to, see whether what's going to work out and hang around the hoop. So I think, communicating with the senior members of the deal team and just saying like, listen, we're really serious about this. We really, we're not going to do something crazy, but we really want to try to be a partner for this guy. So and asking us, what can we do here to, to try to get to that? Because I think there a lot of times there are little things that you can probably do that we can guide you towards, but if you're just waiting to hear from us, that's probably not the right way to make that happen.
Exactly. Yeah.
Okay, really good advice. And with that, I'm afraid we are out of time on today's program. I'd like to thank everybody for coming and registering. I'd like to thank our sponsor, SBS by Bain & Company, for underwriting the webinar and making it possible. And I'd like to thank our speakers for doing a wonderful job on the program. Nadeem Malik of SBS by Bain & Company, Steve Hunter of TM Capital, Nicole Kiriakopoulos of Align Business Advisory Services, and Ashley Kawinga of McNally Capital. Enjoy the rest of your day, everybody.
Thank you.
Thanks, everyone.
All right. Thank you.
Everybody.